Martin for being here with us this evening. There will be an opportunity for a Q&A with the audience, but first of all, I invite you to address the society.
First of all, thank you for the very warm introduction. I should say that before I came here, I was sent very detailed instructions about what was to happen and what I was to do. And the third item was attire. The customary attire for the award ceremony is formal wear. That's me. It's an immense honour and pleasure to have received this really very attractive medal and to be here with you. I've been informed this is the oldest such debating society in the world, and I was told pretty firmly about some of the other people who have been to address you. For some of them, maybe you were not present, since they seem to have included Winston Churchill, Oscar Wilde, Samuel Beckett, Bram Stoker, indeed almost every famous figure in Irish literature and thought. In addition, you may have been present for some of these, some very distinguished contemporary figures: Nancy Pelosi, Joseph Nye, John McCain, Helen Mirren, really distinguished, Bono, and so forth. And looking through this list, I could not even begin to imagine why I'm here. So something went very, very wrong with the selection process this time. And I don't really understand what went wrong, but it's the fault of the organising committee, and you can take it up with them. I also, so first let me thank you all. It's a great pleasure and honour, and I always love coming to Dublin. So it's been a pleasure to be here today. I've also managed to enjoy some very interesting meetings to discuss the improving picture for Ireland. At least I hope it's an improving picture. It may look a little better, a little worse tonight than it did yesterday night. I asked, obviously, what I should talk to you about, and I gave a list of a number of possible topics. And for reasons that I find almost incomprehensible, they chose, the organising committee, not only having made the mistake of inviting me, chose what I consider to be far and away the most arid of the topics that I offered, which was the state of economics. So I'm going to talk about the state of economics, but I'm going to talk about a very specific subset of the issues raised by the state of economics, which is far too vast, complicated and difficult a topic for somebody who's just a journalist like me. So I'm going to talk about the state of economics, or why crises happen. So it's pretty clear the thrust of this. It will be moderately abstract, but I think it will have some substantial relevance to where we are. I will talk for, I think, slightly under half an hour, and I hope that will leave us plenty of time for questions. Should I find I'm overrunning, I'm often a bit optimistic, I will cut it down to meet that time objective. I'd like to say finally that what I'm going to tell you is part of a book I'm currently writing, which is on the subject of how the crisis has changed the world. And one aspect of that, obviously, is how it's changed our thinking about the world, and particularly of the world economy and, as I said, economics. So I think it fits pretty well. It turns out that my book fits very well into the subject that I have agreed to take on. Let me start with 3 quotes, and the relevance will be obvious. The first quote comes from a very important person, Ben Bernanke, now Chairman of the Federal Reserve, but this was from a speech, a very famous speech, notorious one might say, delivered in 2004, when he was still a governor, a mere governor. And his view was, in 2004, remember this is the most important central banker and, for that reason, monetary economist in the world. My view is that improvements in monetary policy, though certainly not the only factor, have probably been an important source of the Great Moderation. In particular, I am not convinced that the decline in macroeconomic volatility of the past 2 decades was primarily the result of good luck, as some have argued, though I am sure good luck had its part to play as well. That does really seem pretty quaint now, doesn't it? The second quotation is from an economist who was completely ignored till this crisis, whose work I did in fact know, but not as well as I should have done, Minsky. And the quote is from 1982, and he said, "Can it, a Great Depression, happen again? And if it can happen, why didn't it occur in the years since World War II? These are questions that naturally follow from both the historical record and the comparative success of the past 35 years. To answer these questions, it is necessary to have an economic theory which makes Great Depressions one of the possible states into which our type of capitalist economy can find itself." So it's a pretty different vision from that of Mr. Bernanke, you would have to agree. And finally, by now an incredibly famous quote from Chuck Prince, then Chief Executive of Citigroup, on the 9th of July 2007, in which he said, "When the music stops in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance." And we are still dancing. What is most fascinating about the notorious remark by Chuck Prince, the man, of course, who led Citigroup into disaster again. Citigroup, by the way, is a bank that has succeeded in going bankrupt 3 times since 1980, is that he saw what was to happen and felt he could do nothing to prevent it. Such was the pressure he was under from shareholders and analysts to whom they listened, that he dared not seek to prevent one of the world's biggest, most complex, and most interconnected financial groups from going ever closer to the waterfall he could see ahead. Yet, in his understanding of the risks, Mr. Prince seems to have been far ahead of the world's most important regulator and central banker. Indeed, though I don't give you all the quotes, even 2 months before the crisis broke upon the world, Ben Bernanke, chairman of the Federal Reserve, had essentially no idea what was about to hit him, his institution, his country, and the world. The turmoil that we have experienced since 2007 has done more than make the wisdom, the notion of the Great Moderation, which I've cited, of even a few years ago look as extinct as the dodo. It has changed the world. And one of the most important ways it has done so is by forcing any serious economist to confront precisely the challenge posed by Minsky and ignored by mainstream economics for much of the past 40 years. Why are crises an abiding feature of market economies? I will explore this territory. I will start with my own intellectual history. I will then ask what I think drives macroeconomic instability, in which I draw very heavily from Minsky's thought. And finally, I will draw preliminary lessons for economics and contemporary economic policy. So first, my intellectual history. I did not foresee a crisis of the magnitude of the high-income countries have suffered. This was not because I was unaware of the unsustainable trends of the pre-crisis era. My book, Fixing Global Finance, which was finally published in 2008, but was based on lectures delivered in 2006, discussed the fragility of finance and the frequency of financial crises since the early 1980s. Nevertheless, I did not expect these trends to end in so enormous and so long-lasting a crisis. So I was guilty of working with a mental model of the economy that did not include another Great Depression, because I think that's what we nearly experienced, as one of its possible states. And I am trying now to learn from this probably unpardonable mistake. Is Minsky's demand a reasonable one? And if so, how should economists respond? Many economists react, even now, by arguing that crises are impossible to forecast. If they were not, they would either already have happened or been forestalled by rational agents. It's a satisfying doctrine, since few mainstream economists foresaw the crisis or even the possibility of such a crisis. And for the dominant school of neoclassical economics in its contemporary macroeconomic form, depressions are as a result of some external, or as economists say, exogenous shock, not of forces generated within the system. The opposite, and in my view, far more plausible view, is that the crisis happened partly because the economic models of the mainstream rendered that outcome apparently so unlikely. This very insouciance, shared by all policymakers and most macroeconomists, encouraged by rational expectations come efficient market hypotheses, made regulators and investors careless. Naive economics helped cause bad economies. When we really misunderstand economics, this changes the world in the sense in which misunderstanding physics, thank God, doesn't. Minsky's view that economics should include the possibility of severe crises, not as shocks, but as events that emerge naturally from within the system, is methodologically sound. Crises, after all, are economic phenomena. Moreover, they have proved a persistent feature of capitalist economies over the ages. As Nouriel Roubini, one of the best analysts of this crisis, and a co-author, Stephen Min, argue in a recent book, crises and depressions are not black swans, rare and wholly unpredictable events, but white swans, normal, if relatively infrequent events that follow a fairly predictable pattern. So this leads me to my second section, which is, well, so why are crises endemic in the system? Why are they both endemic and indeed epidemic, as we know, features of free market financial systems? They often feel like epidemics. The contagion is so obvious. The answer, I would suggest, comes from three closely related features, fundamental features of such an economy. First, fragility comes from debt, and particularly from short-term debt. Second, the short-term liabilities of banks and similar institutions are money, namely claims that the public expects, indeed demands, be both liquid and safe. Finally, credit, and particularly bank credit, moves in self-reinforcing cycles of optimism and pessimism. In upswing cycles, raise asset prices, increase debt, and expand the money supply. In downswings, they cause asset prices to crash and destroy both private debt and money. So I will consider each of these three aspects of finance in turn. First, debt, which is, of course, a wonderful invention. It allows people to transfer purchasing power they do not currently need to those who have plans they cannot currently finance. An important feature of debt, compared with equity, is that lenders do not have to monitor closely what the borrowers are doing. So long as equity cushions are sufficient, lenders can sleep well. With enough confidence, they are able to ignore the idea of default, provided the cushions are adequate. If so, they can also ignore the possibility that there's something important about the borrower that they don't know that somebody else might. It economizes on information. Yet suppose lenders learn that some of their borrowers may be in trouble. They may then become nervous, indeed they will be, about many borrowers, precisely because of their ignorance, even though just a few are known to be in trouble. If enough lenders stop sleeping well, interest rates will jump and the market value of a swathe of loans will collapse. Thus are panics born. Panics would not be such a problem if unpleasant surprises never happened, but of course they do. The consequence of panic would also be modest if the terms of loans were generally as long as the payback period of underlying investments. Prices of loans would then adjust, some borrowers might be shut out of markets for a while, but normal life would continue. But, and I've seen this happen many times, if lenders start losing confidence in borrowers, they will start lending on ever shorter maturities, in the hope that they will be able to exit at the very first sign of trouble. Such maturity mismatches, situations in which liabilities have far shorter terms than the natural life of the assets they fund makes panics even more likely. If everybody tries to go for the exit at the same time, like people trying to escape from a burning theatre, almost nobody will escape. If lenders want to free themselves from the cost of monitoring the ultimate borrower, they can, and indeed do, provide their funds to an institution that will borrow their money and relend it. To be as safe as possible, they may also lend to this institution short term. To encourage people to lend to it, such an institution may be prepared to promise to pay back at par, that is exactly in the value that it receives the money, and on demand. In normal times, lenders, or in this case more specifically depositors, can again go about their business trusting in this institution, which I will call a bank, and not thinking about what it is doing with their money. And that is surely the state of most of us, nearly all the time. This arrangement works very well, except when it ceases to do so. It ceases to do so when lenders start worrying about the health of the institution, maybe because they know or fear something about the loans advanced by their institution, or because they know or fear something about loans advanced by institutions exposed to risks similar to those they think are being run by their own institution, or because they know or fear something worrying about the economy, such as that it's going into a recession. Again, there comes a panic. Worse, a run on one such institution has a good chance of causing a run on the financial system as a whole, either because depositors worry about the similarities among institutions, or because the forced liquidation of illiquid loans by collapsing banks impairs the solvency of institutions holding similar assets. Illiquidity causes insolvency, fears of insolvency cause illiquidity. Now let me turn to the second aspect of this system that I'm sketching in this abstract way to get at its essentials. The aspect is money. The short-term debt of banks and similar institutions is something we think of very happily as money. In our system, institutions whose liabilities are accepted as means of payment are of course able to create money. As Alistair Milne of the Cass Business School at City University notes in a particularly good book on the crisis, and I quote, "Banks create money by lending. Indeed, nearly all the money in a moderately sophisticated modern economy is a byproduct of lending by private banking institutions." So why do people hold money? Well, the obvious answer is to carry out daily transactions. But the bigger answer is that money offers safety. The more money people or business holds, the more confident they can be of paying their way whatever happens. Cash is king. It is the sovereign remedy against a fundamental aspect of a dynamic, innovative, risk-taking capitalist economy, which is, of course, uncertainty. Money deals with uncertainty successfully only if it is safe, both physically and in terms of its purchasing power. People keep their money in banks because this is safer and more convenient, at least they usually think so, than if it remains under a mattress. But there is, of course, a fly in this delicate financial system. People may want their money to be safe, but the institutions whose liabilities are thought to be money are not safe. They are profit-seeking, risk-taking financial intermediaries. Moreover, they are least safe precisely when everybody is most concerned about the safety of their money and most concerned that it should remain money, as I've defined it, namely during a crisis. Thus, banks are necessarily engines of both prosperity and panic. As providers of finance on the asset side of their balance sheets and money on the liability side, the banking system provides essential public goods, but the potential conflict between these two functions breeds crisis. It is inevitable then, given the role and fragility of the banking system, that society has progressively sought ways of containing both panic and the irresponsibility that breeds it. But this is a Red Queen's race, a Lewis Carroll type Red Queen's race. As Pier Giorgio Alessandri and Andrew Haldane of the Bank of England note in a particularly brilliant paper on the crisis, and I quote, "The three longest standing state insurance devices for the banking system are liquidity insurance, deposit insurance, and capital insurance. All three were employed in the most recent crisis. But, as these authors also note, the other side of insurance is regulation. Regulation is intended to limit carelessness, which occasionally morphs into something like reckless endangerment, because the opportunities seem exceptional and the restraints become weak. And I would have thought you in Ireland know all about that. 3, credit. And this brings us to the third feature of a financial system, the credit cycle. Over both time and space, the system that I have described in simple form has generated huge credit booms and busts. What is exceptional about the recent crisis in the US and UK, the countries where the world's 2 premier financial centres, New York and London, are located, is that the preceding booms were so lengthy and the overconfidence so egregious. The late, and until recently disregarded, Hyman Minsky described the broad features of a credit boom and bust. A fundamental characteristic of our economy, Minsky wrote, is that the financial system swings between robustness and fragility, and these swings are an integral part of the process that generates business cycles, close quote. Minsky distinguished in particular between 3 kinds of borrowers, what he called hedge borrowers, speculative borrowers, and Ponzi borrowers. Hedge borrowers, he asserted, are able to cover both principal and interest out of income in almost all circumstances. Speculative borrowers, he argued, obviously these are metaphorical types, are able to cover interest but not repayments out of income. They need, in certain circumstances, insurance of rollover. Ponzi borrowers can cover neither interest nor repayment out of income. They are reliant entirely on future capital gains. As borrowing moves in the cycle from hedge to speculative to Ponzi, borrowers, and so a fortiori also lenders, increasingly depend on rising asset prices for solvency. But of course, trees don't reach the sky, and asset prices never become infinite. Once new borrowers are no longer able to borrow because the terms seem absolutely ludicrous even to the most sane lenders, prices start to stop rising. From ceasing to rise to starting to fall obviously takes but a moment if there are a very large number of Ponzi borrowers in the system. This is now actually called a Minsky moment, a term coined by a friend of mine, Paul McCulley, who was managing director of the so-called Pacific Investment Management Company, or PIMCO, the world's largest bond fund. Once the supply of quote-unquote greater fools has dried up, those who have borrowed on Ponzi terms must sell, and the institutions who have financed on Ponzi terms will try to get their money back, desperately. As that happens, those who have lent to institutions that finance the bubble will also want their money back. That triggers the panic, the systemic crisis, and the recession. The financial sector and the economy crash. The cycle is complete. So, what are the lessons of this for economics, and why was Ben Bernanke's economics so completely and woefully wrong? And let me stress again, that was the economics that governed the thinking of most economic policymakers in important institutions, and most macroeconomists, for that matter. Just go back and look at the literature, I don't have the time here, up to the crisis. First, the conclusion is that the economic system we have is inherently, durably fragile. And that raises questions for macroeconomics and for macroeconomic policies. So let me start with macroeconomics. Economists have tried to construct a vision of the world in which the system for generating money and credit, which I've described, is overlaid upon a multi-period barter economy, a pure real economy, without in any way changing the latter's nature. This vision ignores the fact that the monetary and financial system are institutional mechanisms designed to make such a complex economy work in an environment of fundamental uncertainty. They can't be separated from it, they're integral to it. And these mechanisms have, for the reasons I've explained, have the capacity inherent within them to run away with themselves. One can argue that this is because human beings are myopic, both individually and collectively, and this is true, no doubt. But I would argue that this myopia is itself a consequence of uncertainty. We advance blindly, and being blind are inevitably influenced by the blunderings of others, some of whom at least we think may know more than we do. We are, after all, social creatures. A better understanding of how economies will work than these abstract models will build on Hyman Minsky's instability hypothesis. It will integrate money, credit, balance sheets are crucial, and financial markets into the core of the analysis. None of the important central banks, including the balance sheets of the financial system as an integral part of their analysis of the economy, which seems incredible now. It will almost certainly, the result will almost certainly not be as elegant as contemporary high theory. It will be empirical and institutional instead. It might even be humble. An alternative approach exists to what I've argued. It argues that the free market model will be stable if governments never intervened. Counterproductive regulations, promotion of risky lending, regulatory mistakes, foolish monetary policy, interventions in foreign currency markets, and explicit and implicit subsidies to financial institutions enhance, these people would argue, financial fragility, and they are right. But the proposition that such mistakes are the only source of crises is entirely unpersuasive. Nobody forced households to take on excessive debt, or banks to leverage themselves to the hilt, or both to assume, in many places, that house prices could only go up. In 2006, most of the top economists in the United States were simply unwilling to accept that there could be a general house price fall in the US. They were just wrong. Financial fragility is a consequence of life in an uncertain world. Second, lessons for economic policy. The implication of the approach to understanding the economy I have recommended is that it is government's job, or the job of organs of government, such as the central bank, at the very least to ameliorate the tendency towards instability I have described. And that was, of course, Minsky's view. He argued that the central bank and government taxation and spending could offset the tendency towards implosion at the end of a long credit upswing. And the most recent crisis has surely strongly supported this hypothesis. The early months of the Great Recession, as we now call it, showed incredibly similar collapses in output and trade to those of the Great Depression. Indeed, the work of the great Irish economic historian Kevin O'Rourke shows this with Barry Eichengreen. But aggressive monetary and fiscal policy, along with powerful support for the banking system, halted the slide. Yet, such interventions, and this is the tragic dilemma, tend over time, as Andy Haldane has pointed out, to make the economy and the financial system even more fragile. We have a far more leveraged and far bigger financial system today than we did 100 years ago. The perverse effects of intervention aimed at supporting the financial system through a crisis caused by an over-leveraging of the economy and overextension of the financial system are clear. Some economists, dismayed by this, have even proposed in response that banking as we know it essentially be abolished, being replaced by 100% reserve banking, i.e., in essence, in the contemporary world, banks only fund the government and and the government is solely financed by banks. Money becomes state debt. The most famous proponent of such a plan, this solution to the crisis problem that I've mentioned, was Henry Simon, an early member of the free market Chicago School in the 1930s. You could see why. Other proponents were Irving Fisher of Yale and the young Milton Friedman. And of course the idea does have attractions. It raises a host of huge practical questions. How, above all, would the private economy be financed if we did abolish banking? Would fragility not re-emerge somewhere else in the system through institutions that behave like banks without being called banks? Is that not precisely what happened in the so-called shadow banking system, a term invented by Paul McCulley again when speaking at the Federal Reserve Bank in Kansas City's symposium in 2007? Workable proposals, in my view, are more modest. They are ameliorative. The aim will be to achieve two things: make the financial system and economy less fragile and reduce endogenous cyclicality. The single most important way to achieve this is via deleveraging of both economies and financial intermediaries. And the single most important way to achieve the latter is to introduce large, semi-automatic, counter-cyclical capital buffers, much more capital and with strong counter-cyclical variation. The way to reduce leverage in economies is at the very least to eliminate the copious incentives for borrowing that we currently employ in our tax codes. The forms of finance, particularly property finance, also need to be changed. And in my view, a far greater element of such finance has to take equity form. I strongly support proposals for higher capital requirements for financial institutions instead of a leverage ratio of 30-1, which is simply an invitation to catastrophe. We should be talking about 4-1, as a number of economists have recently argued, including most recently in a brilliant book called The Banker's New Clothes by Anat Admati and Martin Helvig. The idea that equity is costly and scarce is fundamentally nonsense. Of course, the problems of transition to such much higher equity levels is substantial. As the old joke goes, we shouldn't want to start from here, but here is where we start. So that's very last words. I have not tried to analyse in detail what just happened. I have not spelt out what needs to be done now. The purpose of these remarks is different. It's to remind us of the words of Mark Twain, that it ain't what people don't know that gets into trouble, it's what they know that ain't so. Prior to the Great Recession, policymakers knew that inflation targeting would stabilise the economy, that cleaning after a crisis will be better than leaning against financial excess in response to credit bubbles, that we were living in something called a great moderation, for which wise economists and astute central bankers were wholly and responsible. They were wrong on all these points. Worse, they were not just a little wrong. As a result of the stability, there emerged a financial instability, just as Minsky would have foreseen, and that has devastated economies. The underlying paradigms of contemporary thinking of macroeconomic policy failed. We cannot pretend otherwise. That opens up new intellectual possibilities and policy possibilities that are both exciting and frightening, but the starting point, as already said, must be a certain measure of humility. We did not know what we thought we knew. We have to start afresh. Thank you very much.
And insightful talk. To get the ball rolling on our Q&A, first of all, I'd like to ask, our Prime Minister, Taoiseach Enda Kenny, recently made the cover of Time magazine for his leadership during our economic crisis, to the applaud of some and to the criticism and even mockery of others. Do you think that he deserved his spot on the cover?
Oh, this is on the record, isn't it? Well, as I understand it, he can't be held responsible for the crisis. Right? He was elected to office as a result of the crisis. So the question then is, has he done a reasonable job of managing the dire legacy he inherited? Yes, that's the question. And I would have said that given the constraints upon Ireland and the extreme difficulty of its negotiating position vis-a-vis European institutions and European governments, while there are some aspects of what has happened which I think were wrong, particularly the treatment of senior creditors in Irish banks, and it's not obvious to me that he could have done much better. The constraints were very, very binding. And I tend to the view that the Irish were right on what seems to be a collective decision, a national decision, but somebody may correct me, that they should stay in the euro. I think that they were right, because I think the cost of leaving would have been quite dramatic. Which is not the same thing as thinking that it was necessarily wise to join. That's a completely different question. So they decided to join, and having decided to join, they needed to stay in, so they had to do it. So the conclusion I would reach is that in the circumstances, they've done a very creditable job. And as a result, Ireland's plight today looks, in my view, better, and I would say even significantly better than that of any other of the crisis-hit countries. Which doesn't mean you're free of the contagion, because we can see what happens if there's a crisis as well in the Eurozone. So, covers of time, I don't know what that means, but I think actually the current government of Ireland and the current authorities in Ireland have generally done a reasonably good job of cleaning, though it would have been much better if there'd been a lot more leaning before the crisis happened. Obviously, crisis management of the economic system, particularly the lending, the property lending, the guarantees offered at the beginning of the crisis, this was all a catastrophe. But I think the present government has done pretty well compared to all the others, and I think the Irish people have done even more remarkably by putting up with it all.
To ask one more Irish-centred question, among Irish academics, there is often great dislike for commentators who do not have heavyweight academic credentials.
Yeah.
A kind of classic example of that would be David McWilliams, who is very outspoken and a bit of a media favourite, but disliked by academics. Do you think that the qualifications or credentials of commentators should be given much bearing, given your decision yourself not to pursue a PhD?
Yeah, I think if academics think that I'm an unqualified barbarian pontificating on subjects of which I know absolutely nothing, they're fully entitled to their opinion. That doesn't mean I agree with it. I'm being a bit facetious, because first of all, I think anyone has a full right to opine on economic matters, because the science is not exactly solid, as I've tried to imply. And academic economists are subject to facts, but even more, they're subject to blinders which are related to their theoretical models through which they work, the model which work, which can be grossly misleading, as I've tried to imply. My own experience in the last 20 years is that very often market practitioners and economists who work with market practitioners, most of whom are not academics, have a much better sense of what's going on in this part of the system that I've talked about than academics, because they see it daily and they have a better understanding of it. So it seems to be absolutely clear that the idea that academic economics is the only basis on which you can analyse and comment on the economy is sort of pretty absurd. I do think it helps to have some understanding of economics, which comes from a reasonable education, if only if the result is to understand the weaknesses of the models. But no, as a general proposition, I don't think it is true that to be a useful commenter on economics matters, you have to be an academic economist. And in my case, as you know, since you've obviously been reading up, I did the MPhil in Oxford. If I had stayed on, I would have done a doctorate, which would have been a narrow and I think completely useless thesis, which would have added next to nothing to my understanding of anything important, and would have contributed zero to the welfare of the world. I regard the doctorate as a hazing ritual whose only purpose is to diminish the amount of competition for academic posts. It has no other significance. There have been a few theses written by geniuses which have become extraordinary works, even in economics. I can think of two at once, but they are extremely rare. And the fact that I didn't do a doctorate is certainly not relevant to my understanding of economics. I did work as a professional economist for quite a while, and that did teach me quite a lot. I worked at the World Bank for 10 years. But the basic answer is, I think it's useful to understand a bit of economics if one's going to write about this. It is very important to be able to identify nonsense when it's being argued for as a result. But the idea that all commentators, or obviously market practitioners, have to have doctorates in economics or even more be professors strikes me as really laughable, but I would say that, wouldn't I?
I was going to ask whether you thought that academic economics had become too insular, but I think the answer might be kind of clear.
The answer, I focused on one aspect, which happens to be the one I focused on most recently. And there are many different aspects of economics. And even in what I've said here, there are aspects, behavioral economics, which I haven't touched upon, though it's implicit in a lot of what I said. The problem with this set of thinking is not only that it's worse than that academic economics became insular, I don't think that would matter so much, is that the thinking of academic economics, for reasons which I think are obvious, suffused all the policy-making institutions. There were other reasons for that, but I think it was very damaging. So I would say, take the Bank of England, an institution I know well, that their understanding of how the banking industry actually works and how the sources of the instability of the banking industry were worse in 2005 than in 1975. And the main reason was it had been taken over by academic economists. And that's really rather a catastrophe. I've thought for some time that, and there are others, this is an interesting comment. When we design bridges, we don't go to theoretical physicists. Although, in principle, the forces at work can be reduced to theoretical physics. You could do it that way. But in fact, we go to engineers. And because engineers have specialized in how actual structures work in the actual world, and have built up a huge amount of experience, a lot of it rules of thumb. I think we need a very similar sort of distinction among in economic policy making, that being a great theoretical economist, operating with very abstract models, I think helps you basically not at all, and I mean not at all, in making useful policy decisions in a very complicated institutional world, which is what I've tried to describe. And then, for example, if you don't really understand how banks operate in this particular time now, you don't know what's going to happen. And so we need more economic engineers. And we should be trying to produce economic engineers. And having read a lot of Minsky recently, and I've been very influenced by the way he thinks, but he's not the only person, I think that's what he was trying to do. He was trying to build specific models that work in specific contexts, because they seem to him to represent how actual firms and households operated now. That tradition, which was already there, for instance, in some of Keynes's work and after him, disappeared from economics, more or less, until the behavioral economics revolution, this part, re-emerged and has not been fully integrated. I think the results have been disastrous. So we have to think about how we use this sort of system of ideas in practical situations of the type that I think is open.
I think now might be a good time to open questions on the floor. So yeah, I'll take one here from staff.
Hi, I was just wondering, in similar relation to your speech, I was wondering, you did emphasize the Glass-Steagall Act. I was wondering if you think that it had a role, or essentially dismantling of it in some elements of subsequent crises, and do you think it was like an argument for reinstating it, or if that would be an amendment?
Okay, is there anyone in this room who doesn't know what Glass-Steagall is? No. Okay, then I will explain. So, good for you. I don't know what to say. Okay, this has become very real for me for reasons I will mention in a moment. After the in the Great Depression, actually, the U.S. Congress passed a law. One of them was a senator, and one of them was a congressman, and I can never remember which. But anyway, Messrs. Glass and Steagall. Probably somebody knows who was the senator and who was a member of Congress. But anyway, a member of the House of Representatives. This doesn't matter. And the essence of this law is that it legally separated retail commercial banking from investment banking, forbade investment banks from doing commercial deposit-taking business, and created a separate category of broker-dealers. And this structure was pretty well unique to the US. In the course of the 1990s, you could go back into the 70s, this borderline broke down, and finally in the late 1990s, the Act was repealed, and this allowed the retail banks, the main consequence of it was that, though this is a very debatable, this reflected, but also was caused, a situation in which the big commercial banks absorbed investment banking into their daily business, which meant they became huge trading houses, they became enormous operators in the creation and trading of derivatives in particular, and the contemporary universal bank was emerged. Now, I'm interested in this because, for different reasons, which I don't think I want enough time to explain, I was a member of the UK's Independent Commission on Banking, and our proposal was that we would create a modified version of this by ring-fencing the retail bank from the investment bank within modern, contemporary British universal banking groups. The idea being that it would be easier to resolve a bank if we separated them, and that the investment banking culture would be less likely to contaminate the retail bank if we separated them. But there was still some benefit in diversification from having them within one group. I don't want to go into this. The only point I would make is I do think the complete merger of the two sides of the business had something to do with this crisis. And in particular, it allowed certain sorts of risks to emerge which would not have emerged in the same way within a pure retail banking structure. But there are two big qualifications to that, so I wouldn't say it's the core of it. First, as you know very well, because gosh knows you must know in Ireland, retail banks can blow up very satisfactorily by making a very large amount of very, very bad lending, and they did that in many places. They did it in Spain, they did it in the UK, and actually they did it here, and of course to some degree they did it in the US. Second, to the extent that retail banks were constrained in different ways, the US in particular developed a whole host of other ways of financing a housing bubble with the so-called shadow banking system, as I called it, very complicated entity, which though it had something to do with the new universal banks, was not essentially separate from or distinct from the universal banks. So what I'm trying to say is, though I think there is an argument for this split, I actually think that given the conditions which I haven't been able to talk about at all here, I didn't talk about the specifics of this crisis, that given that what happened, even if Glass-Steagall had continued to exist, we would have had a pretty similar crisis. And so I don't think that's the core of it. Basically, the core was conditions were created by the world economy which encouraged asset price booms. And two, in the process of the creation of these asset price booms, particularly housing booms, again, typically, but to an extraordinary degree, there emerged an immense amount of lending in many different ways, in which essentially there was lending with no equity in the system at all. Basically no equity in the system at all. So there was no loss-bearing capacity. And that made the system incredibly and unbelievably fragile. And that's what I've tried to talk about. And I think that could have been done in many different institutional frameworks, once you accept the idea that the system is able to generate leverage freely and you're not going to do anything to stop it. And that was the core of it. They decided in principle that they should do nothing to stop it because they thought bankers knew what they were doing. That was the essential idea. That's the rational expectation side of the story, efficient market rational thinking. They thought bankers knew what they were doing and were able to manage their risks, and they were wrong.
Any other questions? Yeah, Sean.
So Ireland and Iceland both had enormous crashes, but you can see today that Iceland seems to do relatively well, and Ireland is still doing pretty poorly. If we refuse to socialise the bank debt like they did, would we be in a position that is similar to them? And if so, how much do we have? How much does Europe have to? How much responsibility does Europe have in terms of forcing us to keep that bank debt on their national books?
I think that if Ireland could have defaulted to its foreign creditors from the beginning, it would have helped substantially. It wouldn't have helped as much as Iceland, because my memory is that the ratio of foreign creditors to the balance sheet of the Icelandic banks was substantially greater than the ratio of foreign creditors to the balance sheets of the Irish banks. And I wouldn't know the details here, but so my sort of rough and ready, somebody will correct me, but my rough and ready understanding is that the foreign creditors to the balance sheet of the Irish banks would have probably been something like 50%. Would that be wrong? Would it be very different for 50%? In the Irish case, in the Icelandic case anyway, it was about 80%. So there were far more foreigners to default to. Defaulting to domestic citizens is always very troublesome. They tend to get very upset. So and the Icelandic people didn't do that. They defaulted to foreigners. Because they defaulted to foreigners and they could separate out the domestic activities of their banks from the foreign activities of the bank, they could force the burden on foreigners. It did create a little war with Britain and a little war with the Netherlands, and we used the Terrorism Act against them, and they've never forgiven us. But they got away with it, right? And this allowed them an enormous default. The reason they did it, of course, this is the second point, is that their banking system, if I remember correctly, the balance sheet of your banks were something like 5 or 6 times GDP. You can correct me, but that's my... Theirs was 11. There was absolutely no way they could have bailed this out. They were blessed by having a bank, Cyprus may be in the same situation, I don't know, but they were blessed by having a banking system so big that it wasn't possibly salvageable. It had to go. And unfortunately, you, rather like Britain actually, were at the limits of what could just conceivably be born, which is a great tragedy. What you needed was more excess, not less. Because then you would have just thrown up your head and said, that's it, it's gone. But the third element of it, of course, which is crucial, I'm afraid, then comes back to the euro. Iceland has a central bank. It's a sovereign central bank. That means that, it produces a funny money, which goes up and down, has had lots of inflation, but it means that once they decided to default on the whole thing, and obviously there was no foreign money provided to Iceland at all until they got the loan, but they had a bank that could act as a lender of last resort to their banking system, so their domestic banking system could continue. The question, to my mind, in the Irish case, given that your central bank is part of the European system of central banks, if you'd done a default, which the ECB would have regarded as an unfriendly act, putting it mildly at the time, would the ECB have been prepared to support the rump Irish banking system? And the answer to that is it's not obvious. Probably the Irish government authorities felt that they couldn't be sure they would, in which case Ireland ceases to have a banking system. And if Ireland ceases to have a banking system, it ceases to have an economy. That's really rather scary. So if you have become a part of a monetary union without your own central bank, the freedom that the Icelanders have is gone, which is why when I discussed this with Iceland, I was in Iceland a year and a half ago, discussed this, I said, why don't you want to join the euro? You could never do this again. So there were very real constraints. On the other hand, you got some help. One final point. The Irish government might not have got into that difficulty if it hadn't started off by guaranteeing everything. Everything drove on that, even though it wasn't. And what is interesting about the decision to guarantee everything, as far as I can see, and there may be people in the room who can correct me, is they had absolutely no idea what they were guaranteeing. And so Ireland made it difficult to pursue the Icelandic option, because right at the beginning they said everybody was going to be safe, and getting away from that became very difficult. Icelanders never did this. So for all these reasons, I think these options may not have been available to Ireland. And 10 years from now, it may not make any difference. It may be fine. But I think the Icelanders were absolutely right to do what they did in their circumstances. They had no alternative, and they've come out of it reasonably well. And in your case, I think it would have been sensible, given what had happened, to have had a strategy from the beginning of working out how you could default to senior creditors and make that a principal objective. But that would have depended on understanding the situation, which obviously wasn't there, and working out a strategy for doing it, which would be very, very difficult. But in the end, Ireland has decided, as a fundamental matter of national destiny, it seems to me, that it is part of the Eurozone, and therefore part of Europe. And the Icelanders have not yet made that decision. And you have to accept the consequences of choices of that scale. These are existential choices, and I don't think you can get away from them once you've made them.
Next.
On a similar note, what is your understanding of views of the Irish primacy note issue?
My understanding from the discussion I've had in recent weeks is that Ireland has come up with a pretty neat trick which it seems to have got away with. And that's all I can really understand about it. And it seems to make a debt which shouldn't exist, for reasons we've discussed, relatively affordable for the Irish state. It, of course, leaves, from a liquidity point, it leaves Ireland with a very large amount of debt, which really it shouldn't have. Far too much assumption of losses by the Irish taxpayer. That goes back to the previous question. But given that, the deal seems to be rather a smart deal, which has reduced substantially the immediate burden, as I understand it, of the debt contracted as part of this structure. Once you've assumed the debt, the only issue then gets what are the terms of the debt. Ireland has clearly ended up, as a result of this crisis, with a monstrous amount of debt, and which is potentially, over time, provided Ireland does well, I think, just about manageable. But it must be pretty depressing. Emigration is, I suppose, a possibility.
Do you think that the promissory note deal is a bit of a double-edged sword in that the perception of our debt may have gone down, which makes it harder for the government to legitimise making expenditure cuts?
Well, I don't think it makes sense to me, and I'm not an expert on this, for a government to mismanage its debt in order to mismanage its spending policies. So I don't think it's a good excuse to, we need to savage up government spending, so we have to make the debt so terrible that we have no option. That strikes me as a really insane way to improve the public finances. So a government's job is to manage its spending in light of its potential income in the best way possible. And that's always a political issue. And the government's job is to manage its debt as best as possible, and not to mismanage its debt in order to savage its spending. That strikes me as sort of, I shouldn't say this, but almost an Irish idea. I mean, it's absurdly masochistic. Why should one even contemplate it? So no, they've got to do the best they can. The tragedy of the whole crisis is that the Irish state has ended up with far more debt than it ought to have ended up with, for a whole host of reasons. But one of them was the practice insisted upon by the Europeans even to this day, that the interest of taxpayers should be sacrificed to the interests of senior creditors of banks. I regard this, and I've written this many times, as simply insane. And what's more, fundamentally immoral and politically impossible. But if it is the case that the senior debt of banks is more government debt than government debt, then, as I've joked many times, bankers are civil servants and they should be paid accordingly.
I think we have time for one last question. I'll go to you at the very back on the bench.
Do you think Mario Draghi has saved the Eurozone, or if not yet, is he capable of saving it in light of the Italian election result?
No, what he's done, he's certainly not saved the Eurozone. I wrote about that last week in a column I was particularly proud of, so I recommend it. What I think he's done, well, what I thought he'd done, though I wasn't all that, I'll take a second to get through this. The best view is that he's bought them quite a bit of time, because he's removed, or the most optimistic view is that he's removed or substantially reduced a certain sort of liquidity risks, a self-fulfilling panic in sovereign debt markets. And that means that countries should not fall into catastrophe merely because they get to the point at which they have to default on their debt because they can't roll it over, and that brings down their banking systems. And if you bring down your banking, because the banks hold so much public debt, so if you get into a situation in which the sovereign has to default and the banks fail, you get capital flight and you're out. The thing is gone. I think he substantially, with the LTRO, which finance banks, and the OMT operation, which finances governments in principle, he has reduced those liquidity risks very substantially and indicated the ECB would do more if necessary. The crucial thing he said is that we will do whatever it takes to eliminate exit risk. That's a very profound commitment, and central banks are incredibly powerful institutions if they want to use it. So that, I think, is important. What they have not done, and he cannot do, is ensure, or even get close to ensuring, a return to prosperity in crisis-hit countries. That will be determined. He can buy some time, he can improve the public finances, but that's going to be determined by questions of competitiveness, the way of demand in the system, how the whole Eurozone works. And the reality is the crisis-hit countries are experienced gigantic recessions, which are ongoing, except in Ireland, where it's stabilised, but still it's a huge recession, as far as I'm concerned. Immensely high unemployment rates. In a number of countries, as you know, there are 2 countries, the unemployment rates are 25% and the youth unemployment rates are 50%. With next to no prospect that any of this will get better in the next 2 or 3 years. In my view, it's certain to get worse. Whatever, it's certain to get worse. Now, he can't insure them against the political consequences of that. The political consequences of that can be seen in the Italian election. The Italians are not up for this. They're fed up with it. They don't understand it. I can't say that they have been advised. The people who've been leading for most of them for the last 20 years have explained the realities very much. And they're very, very fed up. The risk now, I think, is that one or other country, it could be a creditor country, but I think it's more likely to be a debtor country, simply says enough. They elect somebody or some people who say enough, we're out. We don't care what happens. You know, that is not where we are now. But the Italian election was pretty close to it. In some countries, Spain, for example, the question will arise of whether Spain's going to stay together, I think, under this sort of pressure. So I think he's bought them time, but I still don't see what the end game is. I am not clear how the crisis countries get back to reasonable prosperity within the system. If that's the case, they have a problem. Of course, I think the same is true of Britain, but in that case, it's all our fault. So we can't blame somebody else's. We screwed up. The problem in this case is that if things go very badly wrong, they do blame us. So it becomes a matter of international diplomacy within the Eurozone. That's very troublesome. So I think he's substantially bought substantial time. He's reduced the risk of a quick breakup. He's eliminated the risk of a liquidity strike out of nowhere. But he simply has not and cannot eliminate underlying economic and political risk until prosperity is restored. And by prosperity, I mean prosperity across the Eurozone for most countries. They're put into a position where the people feel confident about the future, confident about the future of their children, are happy with the future of their countries. And it is clear that this hasn't happened, and it is clear to anybody who is looking that the next place that is likely to have a similar problem is France. And once that happens, the crisis really gets serious. They've got a fundamentally unbalanced economic system here, and it's not clear how this will play out, in my view. So I remain of the view that the will to manage the crisis is deeper than I thought. The will to sustain the system is deeper than I thought it would be. I was wrong on that. But it's certainly not fixed yet. And I think we won't know that it's fixed for quite a number of years. The problems will continue to emerge. My guess is it will survive and work. I think it's far more likely than not, but it's certainly not certain. And Mario Draghi cannot deliver it. The only way he could deliver it is by generating a rate of inflation which eliminated all the debt, which would certainly have the Germans out of it. So he has very, very limited capacity. And of course, everybody wants a weak euro, but to do that, he has to pursue monetary policies which match those of the US, UK, and Japan, and he's not going to do that either. So he has really quite tightly constrained. Was that we should stop?
Oh, yeah.
But that was a very powerful and important question. I know I've run over time, for which I apologize.
Not at all. Unfortunately, that's all we do have time for. Thank you to everyone for coming this evening, and thank you to our generous sponsors at class. I'll ask everyone to please remain here while Brian escorts Martin back to the conversation room. But thank you, Martin, so much for joining us here this evening. As one of the world's most influential financial journalists, we're honoured for you to be the latest recipient of our Gold Medal of Honorary Patronage.